So this session is brought to you with support of BSC Limited. They have an investors protection fund, and this works under this particular campaign of investment awareness is under the investment awareness and education initiative of SEBI, the capital markets regulator SEBI. So I've already been introduced. I'm also I am Ahmedabad alumnus, uh, and I'm a guest faculty in a number of institutions. So there are a number of things which this presentation would comprise of. But since we have limited time, I'll just touch base on the most important. But to start with, let me share with you what BSC Investors Protection Fund is about. So BSC Investors Protection Fund is a part of the erstwhile Bombay Stock Exchange, now known as BSC Limited, and I'm sure all of you would know that. So the objective of one of the most important objectives of BSC Investors Protection Fund is to support the investors, become aware and take informed decisions. Now, taking a cue from what Mr. Batra presented in the morning about the importance of employee engagement and taking care of your employees, I would want to share with you the findings of a research which was done about 2.5 years back. So they did this research with some of the Indian employees, and they found that 81% of the Indian employees had faced some kind of financial shortfall between pay periods. Going further, they also found out that 72% of the employees, they had to resort to some kind of financing options. Maybe they drew money from, they took a loan from their provident fund account, or they may have taken a personal loan or borrowed money from some friends, etc., right, just to bridge the gap. 81% of those people who experience this financial shortfall, they also reported mental stress, health problems, and lower morale. Because as we know, in our schools and colleges, now it has started, but the focus on education of the employees on financial literacy is not there. So generally, the employees they become dependent on the so-called advisors, and they tend to go by whatever recommendations they receive, and many times the recommendations that they get from many of these so-called advisors is not commensurate with the needs of those employees, but actually, in terms of what benefits the advisors. Normally, 42% of the employees, they also expect their employers to support them in securing financial well-being. So with this presentation, I would also, urge you all that if you want, it would be our pleasure to, do these webinars as well as physical sessions for your employees. We need minimum 40 people, and this is free of cost. It does not cost anything, because this is under SEBI's, initiative to empower people so that they could take informed decisions. And this is purely educational, no promotion or selling involved. Again, this is also contributed towards employee attrition, because if people are in some kind of stress, then obviously they will, it will impact the productivity, and it will also lead to a lot of stress. A lot of you are psychologists, so you would know about it. I'm sure Ms. Saloni, because she is in HR, I'm sure she would agree with me with all these things. A very important thing, this is something which is very close to my heart. Unfortunately, in India, generally there's this myth that women are not very good investors themselves. And somehow, most of the women, they refrain from taking independent financial decisions. Now we need to bring about a revolution here, because at the end of the day, whatever we learn, it's because of our mothers. Mothers are the real citizen makers. So if women were to start, becoming financially literate, they would definitely be able to pass on this knowledge to their children, and definitely we'll have financial literacy, growing up, or let's say improving automatically. Let's begin with a case study, and I would request your participation here. So, Aniket Bhatia and his wife Ananya, they are working in reputed corporates. And like most of the people, they also believe that they would first want to spend money, right? And then whatever gets left behind, they would want to save. So they believe that income minus expenses is equal to savings. Now, that's what they believe. If whatever gets left behind from their income after they've spent it, that is what they would want to save. So please help me know whether you agree with this notion of theirs, or you think this is the wrong notion.
You want us to put on the chat box, or you want us to speak?
Or you may speak up, please. That's fine.
I think it's a wrong notion. First save what is essential, then spend what is left.
Perfectly. Perfectly. Now, let me quickly give you an example. As Mr. Jawahar very rightly mentioned, this is a wrong equation, right? We need to first, this notion is wrong. We need to first save. Right? And just to quickly tell you, we all are avid, watchers of IPL cricket these days. So just like in a T20 cricket match, there are 120 balls, right? Every team gets to play 120 balls. Whatever they have to do in 120 balls, right? So they would make sure that no ball goes as a dot ball. Same is the case with us also. So normally we would start our careers, let's say at the age of 23. Now people would start their careers at the age of 23. And in corporates, we all know that the age, at superannuation is normally 58. So people get to work for 35 years, right? Now in 35 years, we would get our salaries, or even in business, we would get our income 12 times in a year, right? So just like cricket, we have 420 balls with us. Now let's say somebody starts a career in the first month, but does not invest, does not save money, right? Then it means that ball has gone as a dot ball. It means 419 balls are left. Next month again, the same thing happens. 418 balls, 417, 416, so on and so forth. And I'm sure most of us would agree that by the time we realize that we ought to manage our money in a better manner, already 120, 150 balls are gone, right? So that is the same thing which happens here. It is important that we understand that we first need to save and then spend money, right? Now, just saving money is not enough, because we all know we need to invest money. We need to make our money grow, right? And that is because of a big monster, this invisible monster which we all have in front of us, called inflation. Now, just to give you an example, let us say you put your money, you save your money, and you put your money in an NFT. Let's say you get 7% rate of interest in an NFT. Right? And let's assume that you are in a 30% tax bracket. Which means, because FD interest is taxable, what you would be left with is only 4.9% interest, not 7%, because 30% of 7%, which is 2.1%, would go as taxes, right? So you would be able to retain only 70% of the money. So 7%, 70% of 7% is 4.9%. Now, if inflation happens to be 6%, and if you're getting 4.9% return, then that's negative rate of return, right? We can create wealth only when our rate of investment is more than the inflation rate, net of taxes. It's important that we manage our money. Secondly, just like you would have worked for 35 years, let's say before superannuity. So this is active income, right? This is active income. Active income means for which we have to run. We all know that. If you were to stop running, the income would stop. But more important than that is the passive income, right? So if we were to make sure that we invest our money in a better manner, right, and create avenues for passive income as early as possible, we would really be able to create wealth. So passive income, what are the examples of passive income? Can somebody help me know that, please?
Investment return, the return on your investments that you've made. That's passive income.
Yes, perfectly right. So it could be interest income, it could be dividend income, it could be rental income, right? It could be pension income. So these are different examples. The sooner we start investing our money, we could create assets, and those assets could help us generate passive income. That is what every investor ought to be attempting to do. So where can we invest our money? We could invest our money across different asset classes. What are different asset classes? You could do that in equity. You could invest your money in debt markets, bonds, etc. You could invest your money in real estate, and we have got gold also. Sovereign gold bond, bonds issued by RBI is an excellent product. These are different kinds of asset classes that we have. Now, what would every investor expect from their investments? They would expect their investments to be safe. They would expect their investments to be giving them good returns, tax efficient return, and also liquidity is important. So what is liquidity? It means that whenever you want to redeem your investments, you should be able to do that. If I'm not able to sell off my investments and redeem the money when I want, it means my investments are illegal. So these are the expectations every investor would have. A very important concept is, the investment mantra. It comprises of three things. So normally many investors, they only look at returns, but it is three things which are important. So it's not just returns, but also risk and liquidity, which we need to keep in mind. So let's say you are putting your money in equity markets from a short-term perspective, right? So in that case, risk will be high. If you're putting money in equity markets from a short-term perspective, the risk will be high. Right? If you're putting your money, deploying your money in real estate from a short-term perspective, the liquidity will be low. It would be very difficult to sell off your property in the shorter period. If you want to generate high returns and you invest your money in equity markets from a long-term perspective, the returns will be high. So always remember, three things: risk, returns, and liquidity. So they are like Amar Akbar and three of investments. Another important concept is you should not put all your money in just one asset class. You need to diversify across different asset classes. Now, how much you do that would depend upon the investor's risk appetite, and also in terms of what are their goals, what is the regularity of income, etc. Somebody may say that I would deploy 80% of my investments in equity and 20% in debt. Somebody may say that I would put 60% in equity, 20% in debt, 10% in real estate, 10% in gold. So every investor is different. We need to look at our situation and then invest instead of blindly emulating others. Many investors, they blindly emulate others just because the friend has invested most of his money in equity. I also blindly do that. No. We need to look at our situation, our financial goals, and then invest accordingly. Now, historically, equity markets have given the maximum returns. No other asset class has given as good returns in equity markets. Right? And as you could see, and as you know, equity markets are volatile in the short period. But in the long run, equity markets have definitely given very good returns. So we need to look at it from a long-term perspective, linking your investment to your financial goals. So different asset classes are given different returns across different different periods. But there's no doubt about the fact that equity has given the maximum returns from a long-term perspective. So for all your long-term goals, retirement planning, or let's say children's education, whatever long-term goals are, long-term, from long-term, I mean more than 7 years, right? Actually, more than 10 years, but you can still say more than 7 years. You must consider equity for investment. But remember to spread it across different asset classes. So, how much time do I have, Ms. Kanchan?
Asta, could you please step in to tell us the time? How much time left?
I think 10 to 12 more minutes.
Yes, because 9:32, we'd like to wrap up by 9:45 and we'll need 5 minutes to.
All right. So there are two ways, in terms of investing your money in equity markets. You could do that directly, and you could also do that indirectly through mutual funds, right? So there are two ways to do that. When you are investing money directly, you could invest money in equity markets through the primary markets also, which means IPO, initial public offering, etc. Or you could do that through the secondary markets, which means once the company has got listed, thereafter all the buying and selling happens through the stock exchange. Those are called as secondary markets. The other way is that you could invest your money through mutual funds. That's also a very good way, right? Normally, including me, most of the investors, they do through both the modes. They do investments directly also and through mutual funds also. In mutual funds, you could invest your money in lump sum also and systematically also. I would suggest that for your long-term investments in equity markets, it is better that you invest money systematically instead of going for a lump sum investment in equity markets. The lump sum investment in equity markets are fraught with much higher risk. So SEBI is the regulator of capital markets in India, and the main motive of SEBI is protection of investors' interests. So SEBI is constantly engaged in developing new processes, systems, etc., bringing in new technology so that investors' interest is taken care of. Now, very importantly, stock market is no magic, as I'm sure all of us know about it. If a company is doing well in terms of its performance, the share prices would rise. That's why we need to do some research and invest in companies which are likely to perform better. It would be a matter of both quality as well as quantity. Quality of management, for example, the corporate governance in the company, right? And also in terms of the quantity, which means the figures. So whether the company's sales are rising or not, their profitability is growing or not, it's no magic. So we should not blindly, invest just because you got an SMS from someone or so-called tip from someone. It's important that we do some study and then only invest money appropriately. If we think that we don't have time to do research, then it's better to invest in mutual funds, because there we'll have a fund manager who's much more experienced, and we can create wealth by investing through mutual fund. In case we feel that we don't have time to do any analysis, but without analysis, you should not invest your money. That's important. So due diligence is very, very important. Importantly, investors need to be aware of their rights and responsibilities. In this short period, the markets would be volatile, right? There would be some trigger, just like recently we had this trigger of some banks in US collapsing. So that led to some kind of fear, of a contagion of similar risk in other banks. So that's why the markets became very choppy, right? But in the long run, the markets will be doing well. So one should not become panicky in the short run. We need to invest from a long-term perspective. Do not fall for any so-called tips, etc. These are all designed to make us become poorer, it's always good to invest after doing some research. SEBI has provided for a grievance redressal mechanism. In case investors have any grievances, they could log into scores.gov.in and get their grievances registered so that they could be redressed. SEBI has also provided for helpline, mail ID, dedicated mail IDs, etc., to support the investors, get their grievances redressed. Mutual funds, again, very, very important topic. If you want, I'll be happy to do it for your employees, a dedicated topic on mutual funds also. We need minimum 40 participants for, so maybe some of you could join together and, we could have one session, one webinar. We could do as many webinars as possible. So there are different kinds of funds. I can also support you understanding, about it in detail. Since the time is limited, I am just rushing with it. Very importantly, please, you may guide your employees to maintain an emergency fund. Emergency fund ought to be, equivalent to 6 times of their expenses. Just in case they face any problems, right? An emergency fund should be able to help them. So mutual funds, are a great way to invest money. Another important thing is the National Pension System, NPS. It's a great, approach towards retirement planning. Maybe some of you may have already subscribed to the corporate NPS scheme and may have been offering it to your employees. But in case you have yourself not subscribed to it, I would, exhort you to do subscribe to the NPS. Tier 1, is a retirement planning scheme, and it also offers attractive tax reductions. Insurance and investments are separate vehicles. So life insurance and investments are separate vehicles. Life insurance only, you need to go for protection, only term insurance. And that should be equivalent to 20 times of your income, plus any liabilities which are there, right? So you must have adequate term insurance. Investments and life insurance do not go together. So do not fall for any temptation or any, selling gimmick. Instead of going for investing through life insurance products, you may consider mutual funds. That's a better option. So life insurance is only for protection, not for investment. Take adequate term insurance. Health insurance is very, very important. Please, you may exhort your employees and they need to have adequate health insurance. I am sure you may have given them cover insurance, but that may be insufficient. So they can take a super top-up cover. But health insurance, as we learned from COVID, health insurance, adequate health insurance is very, very important. This is an awareness session brought to you from PSC Investor Protection Fund. I hope you liked it. I'll be happy to answer any questions that you have.